Today we're talking about how to account for receivables. Okay, so we've touched on this a little bit already, but remember that a receivable is an amount that's due from another party. So it's something that we're owed as a business. The two most common receivables are accounts receivable and notes receivable. Other receivables include interest receivable, a rent receivable, tax refund receivable, and receivables from employees. Accounts receivables are amounts due from customers for credit sales. The graph on this slide shows recent dollar amounts of receivables and their percentage of the total assets of well-known companies. Credit sales are recorded by increasing or debiting the accounts receivable. A company must maintain a separate account for each customer that tracks how much that customer purchases has already paid and still owes. And we talked about this earlier, that would be kept in a subsidiary ledger. The general ledger has a single accounts receivable account, which would be called the control account. A supplementary record has a separate account for each customer called the accounts receivable ledger or the accounts receivable subsidiary ledger. Okay, so this is how we would go about recording sales on credit. So to see how accounts receivable for credit sales are recognized in the accounting records, we look at two transactions from July 1st between TechCom and its credit customer. The first is a credit sale of $950 to Comp Store. The second transaction is a collection of $720 from RDA Electronics for a prior credit sale. So we see here that the first transaction that happened on July the 1st is a credit sale. So we have an accounts receivable from the Comp Store, debit of $950, and then we credit sales for $950. So that's how we record sales on credit. And then once somebody pays their bill, we'll see the example here of RDA Electronics when they went ahead and paid their bill. How we would journalize that is we would debit cash for the amount that they paid us, which is $720, and then we would credit the accounts receivable RDA Electronics $720. Basically the opposite of when we made the sale then, because when we made the sale we debit, so when they pay we credit their particular accounts receivable account. And then we also would have, of course, a debit for cost of goods sold and a credit for merchandise inventory for the cost of the merchandise. But for right now, we're not concerned about that. So now on this slide, we see the general ledger and the accounts receivable ledger after recording the two July 1st transactions that we saw previous. The general ledger shows the effects of the sale, the collection, and the resulting balance of $3,230. These transactions are also shown in the individual customer accounts. So RDA Electronics, they have a balance of $280, so that's what they owe. And Comp Store's ending balance is $2,950. That's what they still owe us. The $3,230 total for the customer accounts equals the balance of the accounts receivable account in the general ledger. So we see here that in a general ledger, this is what we are still owed from our customers. And then we see here each customer has an account. So on June the 30th, we see that RDA Electronics made a purchase of $1,000 from us. So we sold them $1,000 worth of merchandise. So that's what they owed us. Then you see that on July the 1st, they paid $720. So we subtract $720 from $1,000, they still owe us $280. And then on the schedule of accounts receivable, it shows that RDA Electronics still owes us $280. And then we see that for Comp Store, that on June the 30th, we sold them merchandise, the amount of $2,000. That's what they owed. And then on July 1st, they purchased some more merchandise, $950. So then they owe us $2,950. And so that is what is shown on the schedule of accounts receivable is their ending balance of what they owe. Add them both up is $3,230, and then that then would carry over then to the accounts receivable in the account in the general ledger. So sales on store credit card. So we know that many large retailers such as the Home Depot or Lowe's or Walmart or Target, any of those Pennies, any of those places, they sell on credit, and they maintain their own credit cards to grant credit to approved customers and to earn interest for any account that's balance that's past due. And so if the company and if it's their credit card, this is how we would record it. The entries are the same as those described for TechCom we looked at earlier, except for the added interest revenue, because in this case we are charging interest. Okay, so we see here that on November the 1st, TechCom recorded sale on their own credit card in the amount of $1,000. Okay, so we see here accounts receivable 1,000, and then sales credit for 1,000. So then on December 31st, TechCom recorded an adjusting entry to the interest earned at the rate of 1.5% per month for the seller credit card. And so we see here then accounts receivable 15 and then interest revenue 15. Okay, because now the customer hasn't paid us yet, and so because they haven't paid us within the 30 days, then we can start charging them interest. Most companies allow customers to pay using bank or third-party credit cards such as Visa, MasterCard, American Express, and also debit cards. Sellers allow customers to use credit and debit cards for several reasons. The first is that the seller does not have to know who gets credit and how much, because the seller is not the one that's granting the credit, it's the card companies that are doing that. Now, second, the seller avoids the risk of customers not paying because they're going to get their money regardless of if the customer pays or not. That risk is transferred to the card company. Now, third is that sellers typically receive cash from the credit card company sooner than if they had granted credit directly to the customer, because the card company, they'll usually pay it either that next day or within the next few days. Now, fourth is that more credit options for customers can lead to more sales. And usually one of the things is that customers will usually purchase more. If they're going to use a credit card, they usually purchase more. It's kind of a psychological thing because it's not like they're taking cash directly from the wallet and you feel the pain of doing that. So usually if a customer is using a credit card, they're usually going to buy a little bit more. So then to illustrate, if TechCom has $100 of credit card sales with a 4% fee, so that means that the bank charges a 4% fee, and it's $96 of cash is received immediately on deposit, the entry would be a credit to sales for the entire amount of the sale, which is $100. However, TechCom will debit cash for 96, which represents how much cash they actually will be collecting from the bank. The difference of $4, that represents the 4% fee that TechCom has to pay for allowing customers to use a third-party credit card. And so that $4 fee would be debited to credit card expense. Okay, because that's an expense of doing business. Okay, usually that is just straight up deducted from what the business receives from the credit card processor usually. Okay, sales on installment. Many companies allow their credit customers to make periodic payments over several months. For example, Harley-Davidson reports more than $2 billion in installment receivables. The seller reports such assets as installment accounts or finance receivable, which are amounts owed by customers from credit sales for which payment is required in periodic amounts. Most installment receivables require interest payments and can be either current or non-current assets depending upon the amount of time for repayment. Okay, so next we'll learn how do we handle what happens when customers don't pay us. So we know that some customers will not be able to pay on their account, and so the uncollectible amount would be referred to as bad debts. And there are two methods for accounting for bad debts. You either can use the direct write-off method or the allowance method. So when a customer directly grants credit to customers, it expects some customers to not pay when they promised. The accounts for those customers are uncollectible accounts, also called bad debts. The total of uncollectible accounts is an expense of selling on credit. Now, why do customers sell on credit if they expect that some accounts to be uncollectible? The answer is that companies believe that granting credit will increase total sales and net income enough to offset the bad debts. And as I say, companies use two methods in order to account for bad debts, either the direct write-off method or the allowance method. So the direct write-off method records the loss from an uncollectible accounts receivable when it is determined to be uncollectible. No attempt is made to predict bad debts expense. So we see here, if TechCom determines on January the 23rd that it cannot collect $520 owed to it by its customer J. Kent, it records the loss using the direct write-off method as shown on this slide. The debit for this entry charges the uncollectible amount directly to the current period's bad debts expense account. The credit removes its balance from the accounts receivable account in the general ledger and also in the subsidiary ledger for the customer. And so we debit bad debts expense. In this case, it was for $520, and then we'll credit accounts receivable J. Kent in order to clear J. Kent's account, and then as well then the main accounts receivable account. Now, sometimes an account that is written off is actually later collected. So if the account of J. Kent that was written off directly to bad debts expense is later collected in full, then there are two journal entries on this slide that you will use to record the recovery. So you would go ahead and debit the accounts receivable J. Kent, again in this case $520. You would credit bad debts expense $520, because again that removes it from the expense for the bad debt, adds it back to the account, so it reactivates J. Kent, and then the accounts receivable, and then you would debit cash $520 because you're receiving cash amount of $520, and then you can credit the accounts receivable of J. Kent for $520, and so that clears J. Kent's account, records the cash that is received. Companies weigh at least two concepts. When considering use of the direct write-off method. The first would be the expense recognition requires expenses reported in the same period as the sales that they help to produce. Now, the direct write-off method usually does not best match sales and expenses because bad debts expense is not recorded until an account becomes uncollectible, which usually occurs in a period after the credit sale. And also the materiality constraint that we talked about permits use of the direct write-off method when its results are similar to using the allowance method. So now we'll talk now about using the allowance method. So the allowance method for bad debts matches the estimated loss from uncollectible accounts receivable against the sales that they help to produce. We use estimated losses because when sales occur, sellers do not know which customers will not pay, obviously. They expect that their customers would pay them. Otherwise, they wouldn't make the sale on credit. Okay. This means that at the end of each period, the allowance method requires an estimation of the total bad debts expected from that period sales. This method has two advantages over the direct write-off method. And so the one advantage is that it records estimated bad debt expense in the period when the related sales are recorded. And also it reports the accounts receivable on the balance sheet at the estimated amount to be collected. So the allowance method estimates bad debt expense at the end of each accounting period and records it as an adjusting entry. TechCom has credit sales of $300,000 during its first year of operation. At the end of the first year, $20,000 of credit sales remain uncollectible. Based on the experience of similar businesses, TechCom estimates that $1,500 of its accounts receivable would be uncollectible and made the adjusting entry shown on this slide. The estimated bad debt expense of $1,500 is reported on the income statement as either a selling expense or an administrative expense. The allowance for doubtful accounts is a contra asset account. A contra account is used instead of reducing accounts receivable directly because at the time of the adjusting entry, the company does not know which customers will not pay. After the bad debts adjusting entry is posted, TechCom's account balances for accounts receivable and its allowance for doubtful accounts are shown at the bottom of this slide. So we see, to be able to record the allowance that what we think might be uncollectible is we would debit the bad debts expense by the amount that we think is uncollectible, in this case $1,500, and then we would debit that, we would credit the allowance for doubtful accounts of 50. And then also then for the amount that, so we can see that after that's recorded, we see that they had $20,000 in accounts receivable that still hadn't been paid yet or collected yet on December 31st. And then we see the allowance on December 31st of $1,500. And then you also have to report this on the balance sheet. So the allowance of doubtful accounts credit balance of $1,500 has the effect of reducing accounts receivable by its realizable value, or what we expect that we would actually be able to collect. Although credit customers owe $20,000 to TechCom, only $18,500 is expected to be realized in cash collections from those customers. Now, TechCom will continue to bill its customers for the total of $20,000 what it's owed. In the balance sheet, the allowance for doubtful accounts is subtracted from accounts receivable and is often reported as shown here. Sometimes the allowance for doubtful accounts is not reported separately in the balance sheet when accounts receivable is to be reported by where accounts receivable is reported by its realized value, the net of. So we see here two different ways you might see it: is the accounts receivable $20,000, and then you have listed right under current assets and right under the accounts receivable line, you might have it listed less allowance for doubtful accounts. You have the amount of the allowance and then the actual net of what you think that you should collect. Otherwise, you might just list it in one line, and so it'd be accounts receivable, and then in parenthesis you'd say net of, in this case, $1,500 of doubtful accounts, and the amount that you expect to actually be able to realize. So when specific accounts become uncollectible, they're written off against the allowance for doubtful accounts. And so TechCom decides that J. Kent's $520 account is uncollectible and makes the above entry to write it off. This entry removes $520 from the accounts receivable account and the subsidiary ledger. The general ledger accounts now appear as shown, assuming that there are no other transactions that affect these accounts. And so we see here that we have a debit for the allowance of doubtful accounts of $520. That's the amount that we're owed from J. Kent. And then we have accounts receivable J. Kent. We credit that for $520. So that clears J. Kent's account, and then that puts that on into the allowance for doubtful accounts. And so we see here that the accounts receivable then is reduced by the amount, so it's credited by the amount that we were owed by J. Kent, reducing the amount of accounts receivable. And then we see here that the allowance for doubtful accounts is a debit for how much is owed. And so then if you subtract those two, that's how much you still have in as an allowance recorded. The write-off does not affect the realizable value of accounts receivable as shown on this slide. Neither total assets nor net income is affected by the write-off of a specific account. Instead, both assets and net income are affected in the period when bad debt expense is predicted and recorded on the adjusting entry. So we've already taken into account how much we think might be uncollectible. So we don't have to do anything there, changing it. Now, if an account that was written off is later collected, we then have to make two entries. The first is to reverse the write-off and to reinstate the customer's account. The second is to record the collection of the reinitiated account as shown here. And so to help restore credit standing, a customer sometimes pays all or part of the amount owed on the account even after it's been written off. And so on March the 11th, Kent pays in full his 520 balance that was previously written off. So we would have a debit for the accounts receivable J. Kent of 520, credit the allowance for doubtful accounts, basically undoing what we did when we wrote it off. Then we would debit cash 520 because we're receiving cash. We will then go ahead and credit the accounts receivable J. Kent in order to reduce the amount that he owed. And we'll talk now about how exactly we go about estimating uncollectibles based on sales and accounts receivable. Bad debt expense is estimated under the allowance method. There are two common methods. One is based on the income statement relation between bad debt expense and sales. The second is based on the balance sheet relation between accounts receivable and the allowance for doubtful accounts. The percentage of sales method, also called the income statement method, assumes that a percentage of credit sales for the period would be uncollectible. So when using the percentage of sales method, the estimate at the end of the period is determined by taking current period sales and multiplying by an estimated bad debt percentage. The bad debt percentage is determined based on past history of the company and the current economic trends. Also, the sales transactions included in this computation are typically only those that are credit sales. There's no collection issues to be considered, obviously, for cash sales because they're collected at the time the sale is made. So only credit sales. So you'd have the current period credit sales multiplied by the percentage that you think won't be collected. That equals the estimated bad debt expense, and that would be how much the allowance would. And so we see here an example of how we would calculate this. So the percentage of sales method, also referred to as the income statement method, is based on the idea that a given percentage of the company's credit sales for the period is uncollectible. To illustrate, assume that Musicland has credit sales of $400,000 in year 2016. Based on past experience, Musicland estimates that 0.6%, so 0.6%, so a little bit over half of 1% of sales, so 0.6%, would be uncollectible. This implies that Musicland expects that $2,400 of bad debt expense from its sales, computed as 400,000 multiplied by 0.006. The adjusting entry to record this estimated expense is shown here. The allowance account ending balance on the balance sheet for this method would rarely equal the bad debt expense on the income statement. This is because unless the company is in its first period of operation, its allowance account has a zero balance only if the prior amounts written off as uncollected exactly equal the prior estimated bad debts expense. When computing bad debt expense as a percentage of sales, managers monitor and adjust the percent so it is not too high or too low. And so we see here, in order to determine this, we do the math, we determine the amount, and then we would journalize this as a debit to bad debt expense, and then we would credit the allowance for doubtful accounts. And so that is how we would set this up and how we would record the establishment of the estimated bad debts. And then we have another method that we could use, the percentage of accounts receivable method, also called a balance sheet method. assumes that a percentage of the company's receivables is uncollectible. This percent is based on experience and economic trends. Total liabilities is multiplied by this percentage to get the estimated uncollectible amount as reported on the balance sheet as the allowance of doubtful accounts. And so you would take the total estimated bad debt expense, subtract the previous balance in allowance account, and then that would then equal the current bad debt expense. And so we see an example of that here. Musicland has $50,000 of accounts receivable on December 31st of 2019. 5% of its receivable is estimated to be uncollectible. This means that after the adjusting entry is posted, we want the allowance of doubtful accounts to show a $2,500 credit balance, which is 5% of $50,000. Musicland's beginning balance is $2,200 on December 31st of 2018. So during 2019, accounts of customers were written off on July the 10th and November the 20th. Thus, the account has a $200 credit balance before the December 31st, 2019 adjustment. The adjusting entry of $2,300 will give the allowance account an estimated $2,500 balance as shown on this slide. So we take the amount that was currently written off, which is 2,000, and then we had the ending balance for the prior year of 2,200, and so the unadjusted balance then would be $200. That's what is left in there, and so then we do the December 31st adjustment of 2,300 credit. So then that gives us a credit balance then of 2,500. And so we see here that you have a bad debt expense debit for 2,300 and you have a credit for the allowance for doubtful accounts. Aging of accounts method. The aging of accounts receivable method, also called a balance sheet method, a balances sheet method, uses both past and current receivable information to estimate the allowance amount. Each receivable is classified by how long it is past its due date. Then estimates of uncollectible amounts are made, assuming that the longer the amount is past due, the more likely it is to be uncollectible. After the accounts are classified or aged, experience is used to estimate the percentage of each uncollectible class. These percentages are applied to the amounts in each class and then totaled to get the estimated balance of the allowance for doubtful accounts. See here a chart for Musicland. This aging of accounts lists each customer's individual balances assigned to one of 5 classes based on the number of days that it's past due. The amounts in each class are totaled and multiplied by the estimated percentage of uncollectible accounts for each class. The percents used are regularly reviewed to reflect changes in the company and the economy. So Musicland had $3,700 in accounts receivable that was between 31 and 60 days past due. Its management estimated that 10% of that amount of the aging class are uncollectible, or that would be a total of $370. So $3,700 times 10%. Similar analysis is done for each of the 4 classes. And so we see then that the final total of $2,270 shown in the first column of the estimated balance of allowance for doubtful accounts. And so we see here that they list out each one. So we have accounts that are not due yet. We estimate that 10% of those would be uncollectible. From 1 to 30 days past due, we estimate that 5%. 31 to 60 day, we estimate that 10% would be uncollectible. 61 to 90 days, we estimate that 25%, and over 90 days, we estimate 40%. And so if we multiply that percentage by the total receivable that's past due for each one, then we get the estimated uncollectible for each time period. Add those together, then we get our total estimated uncollectible. So now notice that the allowance account has an unadjusted credit balance of $200. The required adjustment to the allowance for doubtful accounts is $2,070. We could also use a T account for this analysis as shown on this slide. This yields the following end of period adjusting entry that's shown. And so again, we have 200 in there. We know that it should be 2270, so then we only have to record 2070 or $2,070. So we have a debit for bad debt expense of $2,070 and then a credit to the allowance for doubtful accounts in that amount. Now notice that if the allowance account has an unadjusted debit balance of $500, the required adjustment would be $2,000. If it has a debit balance already, the allowance would be $2,770 because we need to add the $500 debit balance to the desired ending balance. Because they already had that, we have to add it in order then that when you come out, then you're going to come out with $2,270 credit. So now this diagram summarizes the three estimation methods and their focus of analysis. The aging of accounts receivable method focuses on specific accounts and is usually the most reliable of the estimation methods. So now we're going to start talking about notes receivable. So a promissory note is a written promise to pay a specified amount, usually with interest, either on demand or at a stated future date. Promissory notes are used in many transactions, including paying for products or services and lending and borrowing money. Sellers sometimes ask for a note to replace an accounts receivable when a customer requests additional time to pay a past due account. Sellers prefer notes when the credit period is longer and when the receivable is for a larger amount. If a lawsuit is needed to collect from the customer, a note is the buyer's written acknowledgement of the debt, its amount, and its terms. And we know that that's anything legal, it's best if it's written. So that helps a lot in court if you can get a note. So the note illustrated on this particular slide shows a promissory note dated July the 10th of 2019. For this note, Julia Brown promises to pay TechCom or to its order, according to TechCom's instructions, a specific amount of money, $1,000, which is the principal of the note, which is the amount that is due, at a stated future date, which would be on October the 8th of 2019. Now, as the one who signed the note and promised to pay it at maturity, Brown is the maker of the note because she's the one that signed the note and promised to pay it at maturity. So that's why Brown is the maker of the note. Now, as the person to whom the note is payable, TechCom is the payee of the note. So the person that the note is payable is called the payee. To Brown, the note is a liability called a note payable. To TechCom, the same note is an asset called an accounts receivable. This note bears an interest rate of 12% as written on the note. Interest is the charge for using the money until its due date. As a borrower, interest is an expense. To a lender, it is revenue. Computing the maturity date. The maturity date of a note is the date the note, which would include principal and interest, must be repaid. The period of a note is the time from the note's contract date to its maturity date. Many notes mature in less than a full year, and the period they cover is often expressed in days. As an example, a 5-day note dated June the 15th matures and is due on June the 20th. A 90-day note dated July the 10th matures on October the 8th. This October 8th due date is calculated as shown in this slide. The period of a note is sometimes expressed in months or years. When months are used, the note matures and is payable in the month of its maturity on the same day of the month as its original date. A 9-month note dated July the 10th, for instance, is payable on April the 10th. The same rule applies when years are used. Interest computation. Interest is the cost of borrowing money for the borrower, or alternatively, the profit from lending money for the lender. Unless otherwise stated, the rate of interest on a note is the rate charged for the use of the principal for 1 year. The formula for computing interest on a note is shown on this slide. It is calculated as principal times the rate times time. So principal times rate times time. And so to simplify interest computations, a year is commonly treated as having 360 days, called the banker's rule in business and widely used in business transactions. We treat a year as having 360 days of interest computation in examples and assignments. Using the promissory note that we saw on the previous slide, there will be where they had a 90-day 12% note, $1,000 note, 12% $1,000 note, the interest would be $30. So again, you have the principal amount of the note, in this case $1,000, multiplied by the annual interest rate, which is 12, multiplied by time, and in this case it would be in a fraction of a year, so 90 days. We divide it, instead of 365, we're going to divide it by 360. So that equals 1,000. So we take all of this. So we have 1,000 multiplied by the interest rate, and we can convert that into a percentage. So decimal point 12 multiplied by 0.25. So we have $30 of interest that would be charged. Recording notes receivable. Notes receivable are usually recorded in a single notes receivable account to simplify record keeping. To illustrate the recording of a receipt of a note, we use the $1,000 90-day 12% promissory note that we've been discussing. TechCom received this note at the time of a product sale to Julia Brown. The transaction is recorded as shown, and so we have a debit to notes receivable for 1,000, credit to sales for 1,000. Now, of course, you would also have to record the cost of goods sales debit and the credit to merchandise inventory, but for right now, we're not concerned about that. We're just concerned, how do we handle the accounts payable in the note? Now, notes receivable and acceptance of a past due account. So a seller may accept a notes receivable from an account receivable customer to allow an extension to pay a past due accounts receivable. So when a seller accepts a note from an overdue customer to grant a time extension on a past due accounts receivable, it will often collect part of the past due balance in cash. So we see here that we assume that TechCom agreed to accept $232 in cash along with $600, with a $600 60-day 15% note from Joe Cook in order to settle her $832 past due account. And so TechCom would make the entry shown below. So we would have a debit to cash for $230 showing the cash that's received, credit to accounts receivable for $600 because notes receivable because we're receiving the note. And then we would go ahead and credit the accounts receivable J. Cook for $832. And then that settles the account, shows that we received cash and note. Now we're going to show how do we record the honoring and the dishonoring of a note and the adjustments for interest. So recording an honored note, meaning that it was paid. So the principal and interest of a note is due upon its maturity date. The maker of the note usually honors the note and pays it in full. To illustrate, when J. Cook pays the note above on its due date, TechCom records the entry as shown. And remember that interest revenue, also called interest earned, is also going to be reported on the income statement. So we see that on December the 4th, we debit cash $615 because we received cash, and that would be $600 credit to notes receivable because that's the principal of her note. And then you will credit interest receivable for $15 because that's the amount of interest that was owed and that she paid. When a note maker does not pay at maturity, that means that the note is dishonored. The act of dishonoring a note does not mean the maker no longer has to pay. The payee continues to attempt to collect. How do companies report this event? The balance of the notes receivable account should include only those notes that have not matured. Thus, when the note is dishonored, we remove the amount of this note from the notes receivable account and charge it back to an account receivable from its maker. To illustrate, assume that J. Cook dishonors the note shown above at maturity. The journal entry to record the dishonoring of the note is shown. And so that means that she didn't pay it. This is what we would have to do. We would have to debit the accounts receivable J. Cook for $615. And then we would credit the interest revenue to show the interest that should have been paid. And then we will debit the notes receivable to clear the note from a notes receivable account. When notes receivable are outstanding at the period end, any accrued interest earned is recorded. To illustrate, on December the 16th, TechCom accepts a $3,000 60-day 12% note from a customer. When TechCom's accounting period ends on December the 31st, $15 of interest have accrued on this note. So $3,000 times 12% times 15 over 360. And so the adjusting entry shown records that revenue. So we would have a debit to interest receivable and a credit to interest revenue. The debit to interest receivable because we know that we are owed that, so it's an asset, and then we would go ahead and debit the revenue to show that on the income statement. So now, when that December 16 note is collected on February the 14th, TechCom's entry to record the cash receipt is shown here, and we'll discuss it. Total interest earned for the 60-day note is $60, and we figure that out because it is $3,000 multiplied by the interest rate, which is 12%, multiplied by 60 divided by 360 because it's a 60-day note. The $15 credit to the interest receivable on February the 14th reflects the collection of the interest accrued from the December 31st adjusting entry. The $45 interest earned reflects TechCom's revenue from holding the note from January the 1st to February the 14th in that current period. So you would have credit to cash for $3,060. Remember, $3,000 is the amount of the note, 60 is the interest. And so you would have a credit then to interest revenue for 45 because that's the revenue in that period. And then you would have interest receivable credit of 15 because you now are collecting that $15. And then you would credit the notes receivable for 3,000 because that's the principal of the note. and then we'll explain how receivables can be converted to cash before their maturity. Companies can convert receivables to cash before they are due if they need cash or do not want to be involved in collection activities. This is sometimes done by 1, selling them, or 2, using them as security for a loan. A company can sell its receivables to a finance company or bank. The buyer, called a factor, charges the seller a factoring fee, and then the buyer takes ownership of the receivables and collects cash when they become due. By incurring a factoring fee, the seller receives cash earlier and can pass the risk of bad debts to the factor. The seller also avoids costs of billing and accounting for the receivables. A company can raise cash by borrowing money and pledging its receivables as security for the loan. If the borrower defaults on the loan, the lender has the right to be paid from the cash receipts of the receivables when collected. So when we sell the receivables, we see that we would debit cash in the amount that we receive. In this case, $19,200, and you would also have to debit the factoring expense, the expense of $800, and that is how much of it you're not collecting and how much of it, so the fee. And then you would credit the accounts receivable then for $20,000, because that clears it off your books, because now you no longer are concerned about the accounts receivable. You've now sold that to a finance company or a bank, and they're the ones that then would worry about it and that are going to collect it. And then when you pledge receivables, then you would receive cash, in this case the amount of $35,000, and then it then converts it into a note. So the note then accounts payable, in a notes payable in the amount of $35,000. So compute accounts receivable turnover and use it to help assess financial condition. Accounts receivable turnover. This ratio provides useful information for evaluating how effective management has been in granting credit to produce revenue. So accounts receivable turnover measures how often on average receivables are collected during the period. The formula for this ratio is shown on this slide. Accounts receivable turnover shows how well management is doing and granting credit to customers in a desire to increase sales. A high turnover suggests that management should consider using less strict credit terms to increase sales. A low turnover suggests management should consider more strict credit terms and more aggressive collection efforts to avoid having its resources tied up in accounts receivable. So Visa's current year turnover is 16.9, computed as 18,358 divided by 1,087. And of course, really, we're talking in millions. So we see that it's the net sales divided by the average accounts receivable net. So this means that Visa's average accounts receivable balance was converted into cash 16.9 times in the current year. Its turnover slightly increased in the current year compared to 1 year ago, 16%. Visa's turnover also exceeds that for MasterCard in each of these 3 years. Both Visa and MasterCard seem to be doing an adequate job managing their receivables. And I think also a reason for that in the case of this is that MasterCard is obviously a lot bigger company, or Visa is a lot bigger company, and so that's also, they probably have more customers as well. So why, in this case, why it would be. All right, so that is the end of chapter 9.